Welcome to the Deep Dive. Today we're tackling a really fascinating situation in the market. A company showing amazing financial results, but simultaneously getting hit hard by some, well,
Wow.
pretty intense cultural headlines.
Yeah.
Yeah, we are diving into Netflix, that's NFLX, of course. We've got a stack of reports here, their latest Q2 earnings from 2025, which look great. Deep dives into their competitive strengths, but also the, frankly, immediate market reaction to this cancel Netflix's stuff that blew up recently.
Exactly. So our goal today is to sort of untangle these two threads. You've got the strong business fundamentals on one side, and then this very sudden, very public sentiment shift causing volatility. We need to separate the signal from the noise. And before we dive in, the usual very important reminder. This is purely for informational purposes. It is absolutely not financial advice. Always, always do your own homework before making any investment decisions.
Okay. Right. Essential reminder.
Yeah.
So just for context, as we're looking at the source data, NFLX is trading around, $11,138.99. It dropped nearly 3% in one day because of this news we're about to get into. Still, a massive company market cap, over $484 billion. So the market's clearly wrestling with this. Is the business strong enough to ride this out? Okay, let's park the drama for a second and look at the core health. Before all this recent noise, what did that Q2 2025 report actually show? How's the business really doing?
The reports basically called it robust. Operationally, they really knocked it out of the park, exceeding expectations. Q2 revenue hit almost $11.1 billion. That's nearly 16% growth year over year. I mean, getting double-digit growth at that scale,
Yeah.
that's impressive.
And it wasn't just hitting the quarterly numbers, right? Management seemed pretty bullish about the rest of the year, too.
They really did. Because things were looking so strong, they actually raised their full year 2025 revenue guidance. Now they're expecting $44.8 billion to maybe $45.2 billion. And maybe even more importantly for profitability, they bumped up their operating margin target for the year to 30%. That's up from 29%.
Right, that margin increase is key. It suggests these newer strategies like the ads are really paying off.
Exactly. And it tells you they expect those to be pretty profitable moving forward.
And the cash generation. It's just phenomenal. We talk a lot about profit, but free cash flow, that's the real oxygen for a business like this.
Absolutely. Free cash flow, FCF. That's the cash they have left after everything. Operations, investments, the works. Their guidance for 2025 FCF got a huge boost, now aiming for $8 billion to $8.5 billion. And get this, their trailing 12 months FCF is already at $8.5 billion.
Wow, that's a serious war chest. Does having, $8.5 billion in cash just lying around help them deal with shocks like a boycott call? Does it insulate them better than others?
Oh, absolutely. It provides enormous strategic flexibility. It means they can keep pouring money into content, they can buy back stock, and yes, it means they can weather these kinds of storms, these cultural flare-ups or competitive punches, without needing to borrow money or sell more shares. It's a sign of real financial muscle.
And those efficiency numbers you mentioned earlier. Revenue per employee, close to $3 million. Profit per employee, over $700. Does that mean they've avoided that sort of bloated media company problem?
Well, the numbers certainly suggest a lean operation. When you see figures like that, it points towards, smart use of technology, leveraging their scale, and just a disciplined approach. It's not an organization weighed down by massive overhead. They seem pretty efficient, even operating globally.
Okay, so the financials look solid, cash flow's great, margins are up, but that only works long-term if they keep their lead. What's actually stopping Disney, Amazon, HBO Max, from catching up? What's this wide economic moat really made of?
Yeah, it's interesting. The moat is really built on that massive content library,
Yeah.
but then it's reinforced by their tech and, critically, these new ways they're making money. So pillar number one is just sheer content scale. Analysts keep highlighting their spending on content. The investment, what they call amortization, basically how they account for creating their shows and movies, is set to go over $16 billion this year. 16 billion. That's just a huge barrier for anyone trying to compete globally at their level right now.
Yeah.
And it's not just quantity, it's that local for local strategy giving us hits like Squid Game. That kind of stuff drives retention worldwide.
Okay, $16 billion is the engine. Massive engine.
Yeah.
But how are they paying for it now that just adding subscribers isn't growing as fast?
Right, good question. They basically added two big fuel tanks. First is the ad strategy, the rollout of the Netflix ad suite. That's done now globally.
Yeah.
And it's working. The reports say the ad business revenue is on track to pretty much double this year.
Double. What?
Yeah. So this isn't just pocket change. It's becoming a really significant high-margin revenue stream that helps pay for the next Stranger Things or the next big international hit.
And then there's the tech side. They're not just showing movies, they're using some pretty advanced stuff to make them, too.
Absolutely. They're really leaning into generative AI. The example in the reports was for a show called El Eternute. They used Gen AI for a complex visual effects sequence, and apparently they did it 10 times faster than the old way.
10 times faster.
Mhm.
So that's not just speed, it's cost, too, right?
Yeah.
Makes expensive effects cheaper.
Exactly. It potentially lowers the cost for that blockbuster level stuff that used to cost a fortune. It could give them a real edge over traditional studios on the production side.
Right.
And beyond making shows, AI is tailoring recommendations, making the platform stickier, and they're even testing things like conversational search, talking to Netflix to find something to watch.
Interesting. And they're branching out into other things, too,
Yeah.
like gaming and live sports. But carefully, it seems.
That's right. Their approach is builders, not buyers. So gaming is seen more as like a nice add-on to keep subscribers happy, not the main event. And then you see these big moves into live events, the NFL Christmas games, the SAG Awards, weekly WWE wrestling.
Right, that's a different audience.
Totally. These aren't just random additions. They're strategic plays to pull in different demographics, people who might not have signed up just for the dramas or comedies. It helps with both getting new members and keeping the ones they have.
Okay, so this leads us right into the core tension. We've got this picture of a company firing on all cylinders. Huge cash flow, that $16 billion content moat, new revenue streams kicking in. So why the volatility? Why did the stock take such a sharp dive recently? This is where it gets really interesting.
Well, you've got two things hitting at once, really. First, there's the valuation, and second, these very immediate, very loud headlines. Let's talk valuation first. The stock, it had been trading at a pretty high premium.
Meaning expensive.
Yeah, expensive relative to its earnings or maybe its intrinsic value. The sources noted its recent price, around $1,205, was quite a bit higher than one fair value estimate of about $152. Our own internal target is actually lower, around $1,000.
So what does that premium mean for an investor looking at it? Like, what's the risk there?
It means the market had already priced in a lot of good news, a lot of future growth. If you look at the PE ratio, the price to earnings trailing 12 months, it was up around 47. That's high. It tells you investors are betting heavily on future success.
Right.
And when a stock is priced for perfection like that, any kind of bad news, even if it seems external or maybe short-term, like this cultural stuff, it can cause a disproportionately large drop. The stock becomes really sensitive.
Okay, so the valuation made it vulnerable. Now let's address the trigger, the elephant in the room. These headlines from early October 2025. Sources are clearly saying the stock dropped because Elon Musk publicly called for people to cancel Netflix, tying it into this end woke movement.
Right. And we have to be careful here and just stick to what the market data and the sources actually showed happened in reaction to that. The reports confirmed, yes, the stock fell right after those posts went viral. But the really telling stat, especially for traders, was that short interest people betting the stock price will fall reportedly spiked 20% overnight.
20% overnight, just from those posts.
Yeah, that's what the data indicated. It shows investors, or at least a significant group of them, reacted very quickly, placing bets against the company specifically because of this social media-driven controversy.
Wow. So you have the solid fundamentals we just talked about, crashing head-on with this very public, very sudden cultural backlash. And you can literally see it in the trading data with people rushing to short the stock. It's like fundamentals versus sentiment in real time. So pulling this all together, what does this mean for you, the listener, trying to make sense of it? You've got this financially powerful company, but it's facing a very visible public pushback that's clearly moving the stock price, at least in the short term.
Okay, let's try to synthesize by looking at the bull and bear arguments, kind of summarizing what the analysis points to. The bullish case, the reasons to be optimistic, they're still pretty strong, right? You've got the ad tier working well, the paid sharing crackdown adding revenue, that incredibly strong global content engine, the massive FCF generation giving them a cushion, and that disciplined build don't buy approach seems smart.
It seems like a solid foundation.
It does. But the bearish arguments, the reasons for caution, are also very real and need to be weighed. First, as we just discussed, that high valuation. It was priced for smooth sailing, leaving little room if things get bumpy.
Right.
Second, there's actually a risk of margins getting squeezed a bit in the second half of 2025. Remember that 30% operating margin target for the full year? Well, Q3 guidance was actually higher than that, meaning they expect costs for content and marketing to really ramp up later in the year, probably for big holiday releases. So that could pressure margins temporarily.
Ah, okay. So maybe not perfectly smooth sailing ahead, even fundamentally.
Potentially. And then there's the more qualitative risk, the sort of fuzzier concern that all this diversification into ads, into live sports, might actually dilute the premium brand image they work so hard to build.
You mean some longtime subscribers might feel it's becoming less premium?
Exactly. Some analysts worry about that. Will adding ads and wrestling, while profitable, maybe chip away at the perception of Netflix as the high-end go-to entertainment service for some of those core high-paying users? It's hard to quantify, but it's a risk they flag.
Okay. But despite the recent drama and these potential risks, the analysts covering the stock, on average, still seem pretty positive long term.
Generally, yes. The average price target cited, based on reports from the last 6 months, was around $1,294. So despite the short-term noise and valuation concerns, the underlying long-term story still resonates with many analysts.
So we've seen Netflix's foundations look really strong, that wide moat, the cash, the new revenue. But the stock is also undeniably super sensitive to outside events and public feeling, like these boycott calls causing immediate spikes in short interest.
And that really brings up the key question for you, the learner, to think about going forward. How much does this short-term, sentiment-fueled market noise really matter for the long-term competitive strength? Does that massive $16 billion content spend, that global reach, ultimately insulate them? Or do these cultural headwinds now represent a genuine, ongoing risk factor that could actually impact the business fundamentals down the road?
Yeah, that's definitely something to chew on. Are the moats strong enough to ignore the noise, or is the noise becoming part of the moat assessment itself?
Exactly. Something to watch.
Well, thank you for joining us for this deep dive. If you found this analysis useful and you want more breakdowns of complex situations like this one, please do hit that subscribe button and ring the bell icon. It really helps support the channel. We will see you on the next deep dive.